All right, good morning and welcome to the Pension Committee meeting for the Lextran Employees Contributory Pension Plan and Trust. Today is February 8th, 2022, and my name is Jill Barnett. I am the General Manager here at Lextran, and I will be acting in the facilitator role for this meeting. Before we get into our call to order, I would like to point out that we have a couple of new members on the committee today representing our collective bargaining unit, and those members are Laura Kelly, she is a bus operator, and Mr. Todd Birch, who's also a bus operator. And we have Daryl Sebastian, who has served on the committee previously. So with that, I will call the meeting to order. The first item of business is an approval of the minutes. Can I get a motion from a member of the committee?
We don't have quorum.
We do not have quorum. That's a good point. Thank you. So with that, we will defer the approval of the November 9th meeting minutes to the next meeting. For the new members of the committee, of course, you can certainly review those. Daryl, you were at that meeting, I do believe. So if anyone has any questions between now and then, we can certainly address those. We have the team from Mariner Wealth Advisors with us today, Pam Thompson and Michael Gosney, and we will get into a fund performance report.
Okay, great. Thank you all very much. Welcome, Todd and Laura. It's nice to meet both of you. So you have our presentation in front of you. We always like to start with just a brief update on our firm. Mariner Wealth Advisors is a nationwide investment and wealth management company, but we come to you today from our Louisville office. So we are local. We also have an office in Cincinnati that drives a lot of the investment activities that we have in your portfolio as well. So it's just kind of a highlight on that first page 2. We're proud to let you know we've been ranked again by Barron's among the top 5 advisory firms in the country. So we're always excited to get that new listing as that comes out. So 2021 had us in that as well. The next page is just kind of a snapshot of where we are across the country. That doesn't matter to you so much as the fact that we're here. But it does help us in that we have a lot of different areas of expertise across different colleagues in other areas, and it gives us the ability to pull from that more, and is really a nice way to bring that all together for you. And then the other kind of update page on page 4, this is our local team here. I lead our group. Michael Gosney is also listed here on the page, but this is all the other advisors that are part of our local group. Here as well. It's possible that you would meet some others from time to time. The next several pages are what we always include for your investment policy. The executive summary is on page 5, and then all of the detail is behind that. This is a very important document. This is your document that really gives us the guidelines that we then follow for investing the pension for you. The most critical aspect of that, because this is a perpetual fund, it needs to live forever and continue to pay the benefits for retirement for everyone. It is critical that it grows over time. We get growth from investing in stocks in the equity side of the portfolio, but we don't want to have it all in stocks because we know we can get volatility from time to time. So there's a buffer with that of having some in bonds and then some cash because there's payouts that are being made on a regular basis. So the asset allocation is the most important part of this. The range for the stocks is to be between 50 and 80%. That gives that growth over time, but with that 35 or so, 30 to 40% buffer coming from the bonds. Everything else about the policy is to make sure that it is very prudently managed, very well diversified, not too much in any one stock, not too much in any one particular area. Everything should be high quality and details such as that. And again, the rest of the pages in this section are just the detail of the full policy. Are there any questions, particularly from the new members or anyone, just about the policy before we get into the report? And this has not changed in many years, so it's something that we've always reviewed with you, but there have not been any changes recently. So then turning to the next section on page 17, we like to include just a little bit of a market backdrop for context of the investing environment that we've been in. So behind that next divider on page 17, first is just a review of 2020. We've already seen this is old history, but it's, I think, important context because this was the year that we were hit with the pandemic. the shutdown of the economy that happened with that. The chart here has different colored lines for different kinds of stocks, and they're just listed at the top. These are representing U.S. large company, small company, international, to just give a feel for all different kinds of stock markets. But what's very notable about 2020 is that the very sharp drop that occurred in March as a reaction to the shutdown was very swift and very steep. But we saw a very quick rebound, quicker than most people would have expected. And I think is a very important reminder that the stock market is a forward-looking mechanism. Even though we were still in the horrible throes of this health pandemic, the market was already pricing in the fact that, yes, we're going to get through this, we're going to have a solution and move forward. And there's probably no better example of that than to see, how the market really was rebounding well before we had, the scientific solution to this. The other thing that's interesting is to see how much everything moved in lockstep in 2020. You see, the lines aren't exactly in the same place, but they sure moved. All the ups and the downs pretty much happened in tandem across all different kinds of stocks in 2020. If you turn to the next page, though, looking at 2021, you'll see it's not at all that same kind of lockstep pattern. Much more dispersion between different kinds of stocks. This is more normal. We tend to expect different kinds of stocks to behave differently. And this was a year that we went back and forth between concern over additional shutdown that might occur, so that would be concern over a slowing economy, but then kind of quickly turning to the fact that we actually have a very strong economy now. It's not that people can't find jobs, it's that companies can't find workers in a lot of cases. And the concern over inflation, which tends to come with a very strong economy. Those are two very different ends of the spectrum from what are investors concerned about, and that also leads to a little bit more kind of back and forth and different kinds of stocks working in different periods throughout the year. Overall, though, it was another very strong year by the end of the year for the stock market. So with that context, we'll turn to the portfolio summary. This is on page 19. Here, first we look at your asset allocation. That's in the pie chart. The overall equity allocation at the end of December was at 74%, so closer to the upper end of your range, but in that 50 to 80% range. You can see in the detail then, the largest part of that was U.S. large cap, and that was to your benefit. That was the strongest part of the market. But we did have some mid cap, small cap, international to give that full diversification, which is very important. And then the other 26% being on the fixed income side for some stability and buffer to the volatility of stocks. Then in the upper right-hand corner, you can see the investment returns. And we show you the total portfolio, and then underneath that are the two primary components. So we have a fixed income and an equity return that make up that total. So the total portfolio for the year of 2021 was 17.6%. Much higher. That's more than double what we would project and say you should expect on average. And that follows 2020, which was also very strong, 13.6. But in 2021, that 17.6 came from your equity return of 25%. And then fixed income was flat. Fixed income can kind of be up and down, and we'll get into the bond detail later, but we hold bonds, primarily individual bonds, until maturity. And so that's a very safe, very nice cushion way of approaching that. Bond prices do fluctuate as interest rates change, and that can affect what these returns are, but at the end of the day, the real return that you're realizing in the portfolio is the full return of that bond and the interest on it because we hold it until maturity. So very strong year for 2 years in a row, really. Then turning to the next page is just kind of a snapshot of the past few years in terms of the flow. Just for interest, you can see each column is showing for the past 3 years where the portfolio started the year, the flows in or out, and then where the return came from. There's the number for the dividends and interest. So last year there was $450,000 in dividends and interest. Bond accrual is just a part of the way interest gets paid out, so that's not a big number. But then the market value went up by another $2.5 million last year to bring you to the $20 million at the end of the year. So it's nice to kind of see it in dollars too, of how that works. Okay, I'm going to hand it off to my colleague Michael, who will go into some of the detail then as we look at the stocks and the bonds.
So on slide 21, these are the actively managed stocks in the portfolio, and it makes up 64% of the total equities. We do have a passive investments, and we'll explain that here in a couple slides. But as you can see, we've got these companies in 3 different columns, and they all mean something to the portfolio. The far left column is the growth in income, and these companies typically pay an average or above average dividend, or they grow their dividend at an average or above average rate. Typically these companies are less volatile in nature, which is measured by beta. Anything a beta less than 1 is less volatile than the stock market. The middle column is the cyclical growth. These stocks are typically more opportunistic in nature. They ebb and flow with the business cycle. So as the business cycle changes, so can some of these companies. In the far right column is our high growth. These companies, they tend to outperform. We're looking for capital appreciation versus income from these stocks. They are higher growing companies that will reinvest their earnings back into the company versus paying dividends. And as you can see, we try to keep a balanced approach with these 3 columns. There's a little bit of a higher tilt, so the cyclical and the high growth, but it's still overall a relatively balanced portfolio. Are there any questions on this slide? The next slide shows the top 10 equity holdings, and according to your investment policy statement, we will not hold a position that is greater than 5%. So you can see there's Microsoft is 3.91%. If you also notice, well, the main reason for this slide is to show that we're not overly concentrated in one position. But you'll notice that there are lots of different sectors, so it's not just heavily weighted in technology or healthcare. There's a very diverse sector allocation, which actually on the next slide will show that in graphical form. Healthcare, consumer cyclical, technology, we're very diverse in the way we allocate to various sectors. Any questions so far? Slide 24. So we talked about the active piece of the portfolio. These are the passive investments, and it's 36% of the equities. And we utilize low-cost ETFs. And as you can see, we've got 2 large cap funds. One's a growth index and one is a value index. So we've got kind of the best of both worlds there. We also own a small cap in the Russell 2000, and then a developed international market fund. And you can see on the columns to the right the performance 2021, 2020, and then the 3 and 5 year average. On the next slide, so we talked about the equities. This is the bond review, and it basically just shows the maturity schedule of these individual corporate bonds. And like Pam noted previously, we own these bonds to maturity. We are not looking to sell these bonds. We know that bonds are like CDs, where they have stated maturity dates, stated coupon payments, and the price might fluctuate as interest rates and other things happen, but that doesn't really matter as long as you hold it to maturity. We know what we're going to get for that when that bond matures. And so this just shows the various maturity dates, and what happens is when these bonds mature, they they go to cash. And so then that provides us with opportunities to reinvest that cash into other bonds. And we know interest rates are probably going to be increasing soon. So what that allows is more opportunity for getting higher yielding individual bonds. And these bonds, not only are they corporate bonds, but they are short in maturity. As you can see, 22 to 28, 2028 is the majority of the portfolio, and they are high credit quality as well. So we pick good named fixed income bonds.
And I would just add 2049 and 2099 are not bonds that are held to maturity. Those are preferred stocks technically, and so they don't have the same type of maturity as a traditional bond. They are technically debt of the company, so they get counted towards the fixed income and show up here. But those are not bonds held to maturity, but everything else would fall in that category.
Are there any questions?
So that's the review of the portfolio, and then we always like to include just some commentary on kind of what we're seeing in the economy and our outlook for the market and investments. So if you go into that next section, page 27, versus just looking at, when we talk about the economy, what we're talking about is GDP. So gross domestic product is the total output of our country. A lot of times people kind of get that all, and think that's the same thing as the market. It's not the same. They tend to move together, but the economy itself is what are we producing as a country, basically. So this is looking at GDP going back for the past 10 years, and you can see the very sharp drop that did occur in 2020 with the shutdown. But what's important here is to see that it did come fully back. We have fully exceeded the level where we were before, and continue to grow, and you can even see that trajectory as a pretty, nice rapid pace of growth that we have had, beyond that level. Page 28, this is a little technical, but we really do like to follow the ISM Index Data. ISM stands for Institute of Supply Management, and it's a survey that gets done across manufacturing and service companies. The blue line is for manufacturing, the red line is for service. The measurement here, the way that it works, though you see the dark line drawn at 50, when these indicators are above 50, it is indicating that it is expansionary in those types of businesses. The purchasing managers are literally buying more and doing more, and it's showing expansion. When it's below 50, it's reflecting contraction and things are shrinking. And you'll see that in the past 20 years shown on this chart, there's only a few times that you've had both of those below 50, and those did coincide pretty closely with recessions. And so it's a very, very accurate indicator. Doesn't always give a whole lot of notice before going into recession, particularly when that shutdown was so sudden. But the point here is to look at where those are now and how far above 50 they are, that we are very far into expansionary phase right now. So another good forward-looking indicator that way for the economy. The next page, on page 29, we always want to keep an eye on employment. 2/3 of the economy is driven by consumers in one way or another. Consumers need to be employed to earn money to do what they do in the economy. So this is the unemployment rate. You can see how high it got back with the shutdown. It is now all the way back down to 4%. That is widely considered a very low, healthy level. And so we just had a reiteration of that last Friday, a very strong jobs report again. However, the problem now, I should say the rising concern on page 30 is, like we said, the opposite, is that there are so many job openings that employers are having a hard time filling. So on page 30, there's a few different things going on here, but the focus is that solid red line, I should say. That is a reading of the number of job openings that are out there. This is going back for the past 10 years, and you can see that that number of job openings is at an unprecedentedly high level. And so it's really the case that it's the employers who really need to find workers to fill their jobs. What that can lead to is an increase in the cost of labor, the kind of labor cost index. And that tends to be very highly correlated with inflation. So it's, generally expected that when the cost of hiring people goes up, then inflation kind of goes with that. So page 31 is showing the latest reading on CPI, which is inflation for December. The overall number was 7% there on the left. That is looking at this past December compared to the prior year. Remembering that the prior year we were still dealing with kind of a decline, so that a little bit makes these numbers higher than they would have been. But it's still, higher than typically what is being targeted. If we take out food and energy, which tend to be extremely volatile, the green bar there circled at 5.5%, that's what they call the core CPI. Still, again, much higher than the target. The Fed's target for that is about 2%. So that has been a concern. Some of it is what everybody calls transitory because it's part of the supply chain issues that are working themselves through the system. However, we would say that this dynamic in the labor market is likely to be the piece of it that can keep this higher than what is targeted for a little bit longer. The reason as investors that we get concerned about inflation is a couple different things. It can lead to slowing down of consumption because things simply cost more. It also leads to higher interest rates. So page 32, we're taking a look at one element of interest rates. This is a 10-year Treasury bond yield. This is going back for 20 years just to show, over time it has continued to come down in kind of a zigzag fashion. And has gotten actually incredibly low. In mid-2020, we had a 10-year Treasury bond that got almost as low as 0.5%, which is ridiculous to a lot of us to think about borrowing for 10 years at 0.5%. That has now come up and is actually, we've just now hit the 2% level. But I would say still very low from a standpoint of, borrowing costs for businesses and consumers that are based on this are still at a low enough level that there's not a broad economic concern from it. But there are investment implications certainly as we do see interest rates start to go up. So something that we want to keep a very close eye on. So turning to page 33, as we start the year, our investment team does like to put a forecast out there. We don't have a perfect crystal ball. But we still want to acknowledge the things that we know, but the things that we don't know. So as we start this year, our expectations are that GDP or the economy does continue to grow and remain healthy, probably at a slightly slower pace due to some of these dynamics, but we would still expect about a 3% growth for GDP for the year. Looking at interest rates, the Federal Reserve controls part of that arena. And they have said that they're going to let rates, start to move up. They will make increases to the Fed funds rate. Treasury rates, the one we're just looking at being the 10-year, we would expect to continue to rise a little bit more, potentially to 2.5%, possibly even 3% this year. And so kind of with that as a backdrop, and then acknowledging where we started the year for the market, which was after 2 very strong years in a row, we are right now putting a highest probability on a pretty mediocre year for 2022, which is okay. After 2 really strong years, we're not at all surprised to see one that could end up being relatively flat. We've put a 60% probability on a kind of 5% move up in the market with dividends. That's about 7%, but 30% chance that it's lower than that. And again, I think investing is a long-term project. We want to think about, the long-term returns, and having some of these, weaker years is to be expected. And then finally on page 34, this is a repeat, but I think so important to remember. Just want to make the point that corrections in the market are very normal. So we hear about them. Not every correction is a crash, so to speak. People talk about the market crashing. This is just simply looking at the overall stock market year by year going back to 1980. Each gray bar is showing what did the S&P 500 do for that full year. Was it up or down, and by how much? And 32 out of 42 of these are positive, which is what we expect. The market goes up more than it goes down about 75% of the time when you're looking at the total year. But it is also showing underneath there's a little red dot and a number. That number is reflecting what was the biggest drop that occurred during each of those years. then, ended up finishing where the gray bar is. So if you focus on the red numbers, you will see, more often than not, it is a 10% or more. Sometimes it's a very large number. Most of those do still finish positive, believe it or not, and we tend to forget about a lot of them because a lot of them are very quick, and it's not the end of the world. And so I think, as we've gone a very long time now, we're actually very, very close to already being in correction territory. We've pulled back. We got down to being down 9%. Technically correction is 10%. Came back up. So we're kind of in that now. We won't be surprised to see one. We don't run and hide from that. We were due for one a year ago, and we've continued to grow very nicely since then. So it's important to remain invested. But just one thing we want you to be aware of and prepared for. And that's why the balance in the portfolio is so important. And we review that each time. So we will stop there. The rest of the behind tab A is just the appendix of reports that were used to come up with the summary pages that we already reviewed. I'd be happy to answer any questions if anyone has any.
Thank you, Pam. And Michael, any questions from members of the committee? All right. If there are no questions, I'd be happy to move on into old business. Do any members of the committee have old business items? It's a quiet group. I should also state for the record, this meeting is being broadcast. I am not a member of the pension committee, but I'm here acting in the facilitator role. Did you have a question, Mr. Combs?
When will we get the next actuarial report from Steve?
Steve, it's my understanding the next actuary report is at the next meeting in May. Is that correct?
Yes.
Okay.
Okay. All right. Are there any new business items from members of the committee? Todd, this might be a moment for you to bring up to the committee the question you posed to me recently in our meeting, if you'd like to comment on that.
Okay, I do have a couple of questions.
Sure, go ahead.
And thank you. From what I see from there, you guys are doing a great job. It's very solid from everything that I've learned a lot about pensions. They're very complicated to understand, and
Thank you.
very impressive how well this funding has done. I believe it's 113% invested right now, which is pretty good. This is excellent. The big question, and I represent our collective bargaining union, the big question we're getting from our people is this. This fund has grown $5 million in the last 3 years. The benefit has only raised $10 in the last 25 years. It looks like there was additional 10-cent contribution in 2011 by the authority. And the question, and let me read quickly, and this is probably more for Steve than anybody, but let me read quickly what the union contract language is, if that's appropriate.
Sure. And if you would, be sure to speak up.
Okay,
So
yeah.
Steve can hear you well.
Says the Transit Authority of Lexington Fayette Urban County Government Pension Plan, adopted as of December 1st, 1973, and now entitled Lextran Employees Contribution Pension Plan and Trust, as now in effect shall be continued by the authority and employees and remain in effect for the duration of the agreement. And it mentions that the contributions are 105 and 122, 105 for the authority and 122 for the employees. But the section C here, it says an actual study shall be, thank you. Study shall be made to determine the plan's ability to pay increased benefits without additional contributions by the employee or the authority. And that's pretty much yes or no question. But in the actuarial reports, it doesn't really say yes or no. It goes right into quotes of how much it would cost to raise it even $10. So the question is here with the, I think, phenomenal growth over the last 3 years. Why can't it be raised, the benefit be raised without additional contribution from the employee?
I think that's probably for Steve.
Steve,
Yeah.
Steve is the,
Steve,
who's on
yeah.
camera, is the actuary.
Right,
Pamela and Michael are the pension fund managers.
right, I understand.
And
Did you understand the question, Steve?
Yes. No, it's not impossible what you say. For example, if total contribution coming in is $2.27 and the actual cost of the plan as it is now, say it's $1, then that means you've got $1. You're putting in $1.27 more than you need to, and you could, if everyone is agreeable, you could, you say, spend that $1.27 on modifying the benefits.
And that will be part of his report.
I'm sorry?
That will be part of the report that we go over next meeting. That, when he does his annual report, that's part of it.
Yeah, he gives us a quote. He gives us a quote from the last actuary's report that says to raise the pension $10 would cost an additional $1.15.
Well, it's not necessarily an additional $1.05 because there was about 20 cents available already. So if the total cost of going up by $10 was $1.05 and you had, say you had 20 cents already, then you only needed to come up with 85 cents.
But the question is in, with our collective bargaining agreement, the study is made to determine the plan's ability to increase benefits without additional contribution by the employees or the authority. So you're saying no, that's not possible, or yes, it is possible?
Well, it is possible, and we'll know more in May at the May meeting.
So it is possible to raise the benefit, just throwing out one number here, $10 a month, without raising the contribution. So I guess the big question is people are seeing this phenomenal growth in this pension, and they're putting in $200 a month, but they're not seeing any increase in the benefit. And that's the big question we're getting from the body.
Yeah. Well, a year ago, there was not anything you could have afforded to do.
I think your question is fair, Todd, and when you hear from Steve, when he delivers the report, the interaction is a bit more informative than just reading it on paper, too. So I think that will be helpful because that will be your first time,
Right.
first opportunity to hear him give that presentation, and also, bearing in mind, which is what we discussed when we met recently, that members of the union contribute to the pension plan, but also administrative employees contribute to the pension plan. Thus, the reason that members of this committee are made up from both groups. There is an administrative member, staff member, who is not able to be here today, and we are also lacking a member of the board to serve on this committee, and we'll be getting a new member shortly. The person who had served. The board member who had served as a member of the pension committee for a number of years recently completed their board term, so we will need to reappoint a member to that seat, to the seat on this group. And so it will be up to the committee after hearing from Steve and his report, then to decide the direction that we would like to go. But
So
certainly.
can that be added to the actuary report? a yes or no question, can it be added, yes or no?
I don't think it's a yes or no question. I think our role as
Well,
this committee is to evaluate the risk associated with it.
I understand that.
I mean, we can make the recommendation that we raise or lower or do whatever change that we want to do. Our task is to consider what that would do to the pension fund down the road. So I do think that, of course, we need to look at how much does that cost and are we willing to accept the risk of doing so?
Right.
So I don't know that it's yes or no. I think it is, let's explore these possibilities and these options. And then if we feel that the risk is worth putting this recommendation before the board, I think that's the direction we need to go. So we certainly should, and I think Steve does a great job in the way that he produces his report to show us different options. I mean, one option might be raising the benefit $10. One option might be earlier retirement or other things that we can change about the plan. But it's our role on this body is to consider that risk of what those changes might do. So I think everything should be evaluated, you know, all the options that we have on the table. Does that?
I can tell you what, sorry, Fred.
No, go ahead.
I can tell you what something would cost, a plan, and I can tell you what other groups are doing, but you all have to decide whether you want to do it because there are other factors that could be involved. For example, you asked me to look at a 20 and out retirement. I can tell you what that'll cost, or I will calculate what that'll cost, but I mean, besides what it costs, you also have considerations of how does that affect, you know, staffing at Lextran, and does it do anything to your health program if you have more people retiring early? And things like that would also probably, you want to weigh those in your decisions.
Any other questions or comments from members of the committee? Steve, any other comments that you would like to share in advance of your report next month? And if not, that's
Well, I
okay
think
too.
that 17% return is great, and I'm sure it will show up in the numbers come May.
All right. Anything else from anyone? Well, since we don't have a quorum, I can't call for a motion to adjourn, so we can adjourn by consensus. Stephanie, do you have something to add before we?
The next meeting date.
The next meeting date
May 10th.
is May 10th.
At 10.
May 10th at 10 a.m. We will anticipate being here in this room. Steve will probably join us virtually. And it is my hope that by that time, for members of the group, that we have a representative from the board of directors with us at that time. All right. All right. Well, thank you everyone for your attendance today. Thank you all for coming. I know it was a short meeting, but do appreciate you and always glad to hear good news that you're able to bring to us. All right.
Thank you.
Thank you all.